With the U.S. markets now closed for the weekend, Nuburu Inc., trading under the ticker BURU, finished Friday's session at $0.48 per share, marking a modest gain of 0.013 or 2.88%. Now, on the surface, a sub-$1 stock posting a small single-day gain is hardly headline news. The immediate expectation for most people seeing a price like that is simple: distress. It signals a company on the ropes, a speculative gamble teetering on the edge of a delisting notice, a name that most serious portfolio managers using a service like Schwab Intelligent Portfolios wouldn't touch with a 10-foot pole. That's the story the price tells. But the reality of what's happening with Nuburu is far more specific and frankly more interesting than just another struggling microcap. The real story isn't about the 2.88% daily swing. It's about the fact that this company's entire fate is tied to the industrial-scale adoption of a very specific color: blue. Specifically, high-power blue laser technology, a field where Nuburu holds foundational patents and a technological edge that could either make it an unsung hero in the future of manufacturing or a forgotten footnote. Let's be clear about the prevailing sentiment, the one that probably has many retail traders on platforms like Robinhood or SoFi Invest either staying far away or making small lottery ticket-style bets. The common view is that Nuburu is a cash-burning machine with a great idea that has yet to translate into a sustainable business. They see the stock's long-term downward trend, the consistent need for financing, and the immense pressure that comes with trying to commercialize a novel hardware technology in a capital-intensive industry. This perspective is not wrong, it's just incomplete. It focuses entirely on the financial symptoms without fully appreciating the underlying industrial problem Nuburu is trying to solve. The deeper take, the one that forces a reevaluation, is that you cannot value this company like a software business or a consumer brand. This is a hard tech industrial play. Its success isn't measured in quarterly user growth, but in multi-year adoption cycles within enormous industries like electric vehicle battery production and consumer electronics manufacturing. The critical question isn't whether they can beat earnings estimates next quarter, but whether their blue lasers can become the undisputed standard for welding copper, a notoriously difficult material for traditional infrared lasers to handle. If that happens, the current stock price becomes a historical anomaly. If it doesn't, it goes to zero. It's a binary outcome that the day-to-day stock chart fails to capture. Analyzing the recent stock movement provides a window into this high-stakes environment. The daily swings are, as expected for a stock in this price range, pronounced. That 2.88% gain came on relatively thin volume, suggesting it doesn't take much buying pressure to move the needle. This is a double-edged sword. While it can lead to exciting short-term pops, it also means the stock is incredibly vulnerable to selling pressure. A single large seller, or even just a wave of negative sentiment among retail investors, can send the price tumbling. This is not a stock for a passive online investment strategy. It demands active monitoring. We're not seeing massive block trades from large institutions, which isn't surprising. Major funds that utilize platforms like Fidelity Wealth Management typically have mandates that prevent them from investing in companies with such small market caps and low share prices. The majority of the volume is driven by individual investors and smaller, highly specialized funds that are making a specific bet on the technology. This is where you see the influence of modern brokerage platforms. The accessibility offered by the Robinhood app or the SoFi trading platform allows a much broader base of investors to participate in these kinds of high-risk, high-reward opportunities, for better or worse. Their collective sentiment is a powerful force in the daily price discovery for a stock like BURU. Macroeconomic pressures add another layer of complexity. We're in an environment where capital is no longer cheap. For a company like Nuburu, which is not yet profitable and relies on external funding to finance its operations and research, higher interest rates are a significant headwind. It makes every dollar of cash burn more critical and raises the bar for securing future financing on favorable terms. Furthermore, the company's fortunes are indirectly tied to the health of the global manufacturing sector. If major automakers pull back on their EV expansion plans due to economic uncertainty, or if consumer electronics demand weakens, the sales cycle for Nuburu's expensive laser systems could stretch out even further, delaying their path to profitability. The reaction to their last earnings call was a perfect illustration of this tension. Management likely spoke about technological progress and pilot programs with potential clients, painting a picture of future potential. The market, however, was probably more focused on the cash burn rate and the remaining runway. In this environment, promises of future contracts are discounted heavily against the immediate reality of the balance sheet. This is the stark difference between a company with a great story and a company with a great business, and right now, Nuburu is still trying to cross that chasm. Sophisticated investors using a tool like the Interactive Brokers trading platform would be dissecting every line of the cash flow statement, trying to model precisely how many months the company can survive without another infusion of capital. So, what does Nuburu actually do? At its core, the company designs and manufactures the world's first compact, high-power blue laser systems. Their business model is to sell this hardware to industrial clients. Why is this important? It comes down to physics. Traditional industrial lasers are typically in the infrared spectrum. While they are great for cutting and welding steel, they are highly inefficient when it comes to reflective materials like copper and gold. Much of the laser's energy literally bounces off the surface, leading to inconsistent, messy welds and a lot of wasted energy. This is a massive problem in industries that are becoming increasingly reliant on copper. Think about an electric vehicle battery pack. It's filled with hundreds, sometimes thousands of small copper connections that need to be welded perfectly for safety and performance. Nuburu's blue laser operates at a different wavelength, around 450 nanometers, that copper absorbs up to 20 times more efficiently than infrared light. The result is a faster, cleaner weld with minimal spatter. This is their entire value proposition, offering a tool that can do a critical job better than the existing standard. They aren't just selling a laser, they're selling a manufacturing process improvement that promises higher quality and better efficiency for some of the world's most important emerging industries. This technological moat, protected by a portfolio of patents, is the company's primary asset. Looking ahead, the future outlook is a dramatic illustration of expectation versus reality. The market's base expectation is for continued struggle. The chart suggests a path towards delisting or, at best, a highly dilutive reverse stock split to regain compliance, followed by more capital raises that would diminish the value for existing shareholders. This is the path of 1,000 other failed microcap tech stocks. That's the grim but statistically likely expectation. The potential reality, however, hinges on a few key catalysts. The single most important catalyst would be the announcement of a large-scale deployment contract with a major auto OEM, a battery manufacturer like Panasonic or LG, or a consumer electronics giant. Such a deal would serve as the ultimate validation of their technology, proving that it's not just a laboratory curiosity, but a commercially ready solution ready for the factory floor. It would provide a significant and recurring revenue stream, instantly changing the financial narrative and forcing a complete re-rating of the stock. Investors looking for investment help should understand that this is what they are waiting for. A second catalyst could be a technological breakthrough that further lowers the cost or increases the power and reliability of their systems, making the switch from infrared to blue an even more compelling economic decision for customers. Comment below with your thoughts. Do you think the EV industry will be the key to unlocking the potential for blue laser technology? Of course, the risks are just as significant and cannot be ignored. The primary risk is and will continue to be financial. Can they manage their cash burn effectively enough to survive until their technology reaches widespread adoption? This is the race against time they are in. Competition is another factor. While Nuburu has a head start and strong intellectual property, they are not the only ones working on blue laser technology. Larger, better capitalized industrial technology companies could enter the space either through their own research or by acquiring a smaller competitor. Finally, there is adoption risk. Big manufacturing is inherently conservative. Retooling a production line is an expensive and complex undertaking. Convincing a major corporation to abandon a proven, albeit imperfect process for a new one is a monumental sales challenge, regardless of the technology's superiority. An individual setting up their own portfolio via self-investing on a platform needs